Let's start by saying that you cannot predict future price movement by any means. But what you can do is focus on risk control and maximize profits from your winning trades, for example. Because we have no influence on whether the price goes up or down, unless you're the part of certain group maybe. But we do have influence on how much we risk when we close a position and when we add to it. The trick is to close initially losing trades with little or no loss and add to winning trades in such a way that you end up with even greater profit. It really does not require complicated strategies, but just common sense and discipline. If you want to earn more, you need to learn how to manage your positions effectively. That's it. Very few people focus on good risk structure creation, and instead they focus on fancy indicators and new strategies every month because the previous one didn't work. And in my opinion, it just pures form of bull. In my opinion, the easiest way to learn trading is to set one simple strategy and follow it. Good risk structure is the basis of trading. Without it, trading turns into just gambling. Risk management is very important so that you can survive the bad times that will come sooner or later and earn money in the long run. You should determine what percentage of your total capital you are willing to lose at most. By setting a stop loss level, for example, it protects you against the market crash and blowing up your capital. This involves calculating what lot size you will use. It's really simple. You search for a lot size calculator and go to the first website to find. Enter your currency pair, the size of your capital, what percentage you want to risk, and at what price you want to take a position, and where you want to place your stop loss. No matter how you trade, your job is to make sure your losses are small enough for your winning trades to cover them and bring you a profit back. Let's say we have an upward trend, gray zones are support and resistance. And let's say that I think that the price can continue the trend by setting a position with 1:1 risk-reward ratio. Let's assume that the price actually goes up, making higher highs and higher lows. And now attention, I see that the situation repeated itself again. The price hit higher low from which it started to break out. So I added a second buy position of the same size as the first one. And now I shortened the stop loss of that first position at break even. And I shortened the stop loss of the second position at the last support. This is so that if, for example, the price drops to test the support again, I do not incur a loss in a first position and only stay with the second one, which protects me from a larger loss. For the sake of an example, let's say that the price continues to rise dynamically. In such situations, depending on the context of course, I close the first position with a profit and leave the second one to cover possible loss in the event of the sudden downward move. In this case, let's say that the price reached out our take profit and everything worked out. It may be that the price will start moving sideways at some point. In such situations I usually, but not always, depending on the context again, I close both positions due to the fact that the price likes to do some strange things like fake outs and suddenly change the direction of movement. So to be safe, I close both at a profit. Now I will show you this with a real example. I got 26th, so we have Canadian Swiss franc. Let's go somewhere in December. I would say we're in a consolidation, the price broke to the bottom and rebounded upwards, so I'll go short. I expected the trend to continue, but we went sideways, so I will close on break even. We've broken down from this local support, so I'll go short again. We're back up, so I'll close this short and go long. We're still walking sideways, so I'll close this position to be safe. We finally have a nice upward trend, so I'm buying it on the rebound. The price is going even lower, so it is hedging this position. I close the short with a profit and open the second long. Unfortunately, the price has reversed its trend, so I leave those two positions and head short again, but in a single amount, not twice, so as not to increase the risk. The price has stopped, so I will close it to be safe. I can always re-enter. I go short again. In this case, the price goes down again. The price increased, so I closed this 2 times buy on break even by adding another short. I know the chart is a bit crazy about all this, but we have to manage somehow. I'm closing these 2 shorts on break even. We have an upward trend, I'm going long to recover. Now is a good opportunity to add to the position. The price continues the trend and I'm adding on the rebound. Immediately the price goes into profit and I close both positions. I will go long because the price has often rebounded from the zone. Here I am adding again. And here again, the price immediately reaches the point where I can sell it safely. Okay, that's it. I'll add up the result now. 146 pips. I think it's not bad. I'll calculate how much it would be without adding to this position. 91, so a difference of about 50 pips. So I think this strategy is quite useful. If you become experienced in this and add the positions correctly, you'll significantly improve your risk structure. This allows you to increase your profits on winning trades, which in turn allows you to have greater risk tolerance in other positions. You can afford to take more risk, which in turn can bring even greater profits, and if the price goes in the wrong direction because you earned more on a winning trade, you are able to cover a potentially larger loss, To sum up, in my opinion, trading is primarily about constantly building experience on your own simple strategy. If you understand that it is impossible to predict price movement and instead focus on risk management, you will save yourself a lot of time. That's pretty much it. Bye.